Titan has raised its stake in Caratlane to 98% by paying 4,621 crore rupees for an additional 27% stake. Analysts have cheered the move, but investors are not rushing to go ahead and buy the stock. You may ask why? Well, Titan shares have had a good run in 2023, gaining over 19%. But the market now feels that the stock is beginning to look a bit expensive. Also, Titan has said that it will take on some debt in order to fund this purchase. Now, when a company takes on debt, the interest on that will then chip in some of its profits. Now, some analysts have said that the deal will be EPS dilutive in the short term. Now, in the context of this Titan deal, let's try and understand the jargon EPS dilutive and also what does stock valuation really mean. First, EPS, or earnings per share, is the net profit of a company divided by the total number of shares it issues. So if a company reports a net profit of 100 crore rupees and has an equity base of 10 crore shares, then its EPS will be 100 divided by 10, which is 10 rupees. And why really is EPS important? That's because investors use a yardstick called price to earning or PE multiple in order to decide if a stock is cheap or expensive. Now, PE is the current stock price divided by the earnings per share. So higher the PE multiple, more expensive is the stock seen to be. So if the price of PE is high in the earnings in EPS, which is smaller, then the stock will look expensive. But if the EPS is higher, then at the same price, the stock may not be that expensive. In simple words, investors don't mind paying a higher price if the EPS is good. When analysts say a deal could be EPS dilutive, what they really mean is they're saying that the profits could be affected in the short term. Next up is PE multiple. Now, Titan shares are quoting a PE multiple of 84 times based on its EPS of the last 12 months. Now, that can be argued both ways. You could say that 84 is a very high number considering that Titan is a mature business and that the growth rate is not that spectacular. At the same time, reputed companies, especially those of consumer names, have always commanded a high valuation for a host of reasons. Good business model, a dominant market share, consistent growth, and even better corporate governance. But here is the catch with companies that quote a high PE multiple. Whenever a PE multiple are already high, markets may not be willing to give a higher multiple unless the company shows that it can grow earnings at a faster rate. And that is why the market was indifferent to the Caratlane deal, though most of the analysts felt it was a good deal.